The Central Bank of Nigeria's 299th Monetary Policy Committee meeting, held on the 20th of February 2025, has decided to maintain the current monetary stance. The monetary policy rate, the MPR, was retained at 27.5%, while the cash reserve ratio remains unchanged at 50% for deposits. That's for deposit money banks, and 16% for merchant banks. Additionally, the liquidity ratio was left at 30%, and the asymmetric corridor around the MPR continued to be set at plus 500/ minus 100 basis points. The decision reflects a cautious approach amid ongoing economic uncertainties. Now, to discuss this, we are joined by Principal Partner Woodridge and Scott Consultant Segun Shopita, who is here with us at News Central. Segun, you're welcome. Thank you very much for joining us this afternoon.
Thanks for having me.
You're welcome.
It's a pleasure.
Now, so did this MPR announcement meet your expectations? Let's start from your personal view.
No, I mean, the expectations were mixed because, you know, the MPR decision is meant to be based primarily on inflation numbers, you know, from the MBS. And the reason that this MPC meeting has been delayed this long is because they were waiting for the MBS, you know, inflation numbers. And with inflation having shaved up 1,000 basis points, all expectations became uncertain. You know, without that intervention, we would have said we would expect the MPC to hold or increase MPR marginally. But with inflation having come down by 1,000 basis points, the natural expectation would have been that the MPR would have to reduce to drive growth, you know. But we all know that inflation coming down to 24% is a result of rebasing, not because inflation itself has reduced. So the MPC decision at the moment is, I don't think they had any other option. I think the only thing they could do was hold, and then they would have to go back to the drawing board and determine how to respond to this rather unusual, if not unprecedented situation.
Unusual and unprecedented indeed. Now, how might the unchanged high CRR levels for both deposit money banks and also merchant banks affect credit availability and economic growth?
Look, the reality is that inflation, you know, from the numbers that analysts have done and other observers, you know, of the economy have done, inflation has slowed down, in truth. It hasn't, you know, we're not seeing a reduction in prices, actually, but prices are no longer growing as quickly, as fast as they used to. And therefore, the next course of action for the CBN should have been to try and begin to stimulate growth. So we would have thought that with the holding of liquidity ratio and all the other numbers at their previous levels, hopefully that would mean that the banks at least will no longer be losing further liquidity, and therefore will still continue to trade. You know, when I say trade, I mean run financial transactions at the level that they currently are doing. But the truth is, we probably will need to see more than that for the economy to begin to kickstart itself again, and for us to see the kind of growth that the president has said we will see.
Now, in tangible terms, can you explain when you mean stimulate growth? In what forms exactly?
Look, the MPC in particular, you know, the monetary policy authorities, they are always playing a balancing act between trying to temper and tame inflation and stimulate growth within the economy. And the instrument that they use primarily is the MPR. And then with all the other ratios, the liquidity ratio, the cash reserve ratio, the asymmetric corridor, all of those things are complementary policies to help the MPR achieve that balancing act between driving and stimulating growth or holding inflation in control. So in a situation where you see that inflation has actually been reducing and you are gaining some control over, you know, consumer prices going up, what you then want to see is that you want to see manufacturers producing more goods, the consumers having more money in their pockets to buy those goods, investors pushing more money into the manufacturing sector and the productive sector because sales are booming. You know, so what all of that should result in is that the banking and financial system should have more money to drive all of those activities. So if the banks have more liquidity and can lend at lower rates, then you should see growth, especially in the real sector. Of course, the services sector also relies on bank borrowing to drive the activity. So the entire economy should benefit from the banks having more liquidity to provide as loans, to borrowers, and those loans also being available at lower rates because NPR is no longer rising. So if you do that, then growth will be a natural consequence, and that's the balancing act that the CBN always tends to find itself having to play.
Well, Segun, as academic as you put it, it sounds like a glimmer of hope. But with the liquidity ratio left at 30%, is the banking sector adequately cushioned against potential shocks? Or could this decision limit their capacity to support a dynamic economy?
No, I think that in truth, look, unfortunately, and I'm going to say this, and it's important that we understand this, because of the rebasing that has happened, we now have a situation on our hands where we've got inflation numbers that is data, and then we've got inflation in reality and in truth, right? So if we look at the inflation reality, then the cash reserve ratio that we have today is necessary. We have to limit liquidity within the system to tame inflation further. The problem is that the inflation numbers from the official data agency of the country says that inflation has come down. So cash reserve ratio actually should be coming down so that we can release more money into the banks, so that the banks can drive growth within the economy. So look, it's a very confusing situation, and I think that the central bank has its work cut out for it with dealing with the reality and dealing with what the numbers are now saying, in the next MPC meeting.
All right, then. Well, thank you very much, Segun. Thank you for lending us your afternoon. We'll look forward to having more on this from you.